Hey there everyone, and welcome back to Weide-Market by Weide-Market. If you are looking to figure out your finances and your personal growth from where you are right now to where you want to be in your financial journey, you've come to the right place. On this channel you'll find content not only about budgeting and different ways of making extra income, but also about your own personal growth and your goals and how to achieve them on the way, on the journey from where you are right now, whether you're broke or just floating by, to financial freedom and financial independence. It is my belief that you have not attained your goals yet, and I have not achieved my goals yet, because there is growth that needs to be taking place between where you are right now to where you want to be. On this video we're going to be talking about trading versus investing, and we're going to be covering 5 fundamental differences between the two, and we'll also talk about whether you should do either or both. Stick around till after the intro. I'll see you on the other side of this. So thank you for sticking around till after the intro. If any of the topics that I mentioned in the beginning of this video interest you, I invite you to subscribe to this channel, hit the like button for this video and hit the bell for notifications for future videos. So getting into the topic of this video. Trading versus investing. Should you do one? Should you do the other? Is one better than the other? Let's find out in the upcoming 5 fundamental differences or fundamental points that we will be covering. So trading versus investing is quite a hot topic at the moment. Some gurus on the social media will tell you that trading is like gambling. Other people again use investing and trading as interchangeable terms. In reality, investing and versus trading should not even be a topic of discussion, since they are vastly different things and you cannot compare the two to each other. With that in mind, let's look at the 5 fundamental differences. So number 1 of the fundamental differences between trading and investing is the holding period of how long you keep these positions open of the stocks that you buy and sell. When you are a day trader, and it's indicated in the term day trader, that you are typically looking to close your positions by the end of the day. In a typical trading session, your trading positions would close within hours, minutes, or even seconds. Yes, you heard right, seconds. Some of the positions close out so quickly, or the market is so volatile at some stages, that there are literally positions that close within seconds. Obviously some of them are not profitable, but that is something that you will learn over time. When you are investing though, you are looking to buy and hold for practically forever. And since you are holding the stocks that you buy for such a long time, you are typically not bothered about the small fluctuations in the market. And because with investing you are doing long-term buys, you are typically more interested in the fundamentals of such companies that you are interested in. And that brings me to the fundamental difference number 2, and that is the way you analyze the market when it comes to trading versus investing. When you are trading, you do consider the fundamentals of the market by looking at the financial calendars, the news about certain companies, or the announcements by the companies that you are interested in. But you do this to understand the short-term effect it could have on the stocks, whether it will go up or down. Even a small amount could give you the profit that you need, depending on the position size that you enter. These fundamental factors have an effect on the stock prices or the forex pairs that you want to be trading. And fundamental and technical analysis should always be part of your trading plan. However, most of the decisions you make as a trader will most likely be based on the technical analysis of what you are looking at. Technical analysis methods and tools are so much that I cannot literally name all of them but here are a few examples. When you do technical analysis, you'll typically look at major support and resistance levels in the market. You'll typically look at moving averages of the trend lines, and you'll look at volumes in the market and whether or not the stock or currency pair that you're looking at is overbought or oversold. Like I said, these are just a few examples, and there are many combinations, unlimited combinations and methods of how to analyze the stocks technically. On the other hand, when you are looking to invest a company, the analysis that you do on that company is completely different to what you would do in a trading scenario. You are a lot more interested in the fundamentals of the company rather than the technical analysis of the immediate price of that stock. Typical examples of these factors that you need to consider as an investor is, does the company actually make money? What market sector does the company operate in? What is the company's price to book value ratio? And will the company profits and revenue increase over the next 2 to 5 years? The number 3 fundamental difference is leverage. And although in some markets you can do margin investing, I strongly recommend against it. Margin investing is a very risky thing to do, and leverage should only be used when you are trading. So what is leverage? Leverage gives you the capability to invest with larger sums of money than what you actually have in your trading account, and this is done by borrowing money from your broker. Leverage doesn't only give you the capability to buy more than what you have in your trading account with, but it also gives you the capability to sell or short your stocks. This means you enter a position into the market at a higher level and predicting that this stock or forex pair will actually go down. A practical example of how leverage works is if you have, for example, a cell phone, and you know that you can get this cell phone from another retailer at a lower price, you sell this cell phone for the retail price, and then you go buy the same cell phone at a discounted price, and then you've made profit between what you've sold and what you've bought at. So in practical terms, leverage gives you a bigger upside in the trades that you are profitable in, but the risk with leverage is also that you have a bigger downside. So what will happen if you predict that the market will go down, or let's say that you predict that the market will go up and you buy into a position, and then the market actually turns against you. Not only do you lose your invested margin, but you also have to pay back the broker for the money that they borrowed you to actually do that trade. Without the knowledge and experience and the plan and strategy, you increase your risk. And that brings me to point number 4, about the fundamental differences between trading and investing. It is Warren Buffett that said that risk comes from not knowing what you are doing. But even though you might have a plan, you might have a strategy, you might have a mentor, you need to know, and this is a real serious warning, that there is risk. You can lose the money that you trade with and that you invest with. So never borrow money from a bank or a friend or a family member to invest or trade with if you do not know exactly what you are investing in and how you will profit from that investment or from that trade that you do in your daily trade strategy. I speak from personal experience when I tell you that the risk is real. I've only been trading for less than a year now, since June 2020, and I have pretty much made every single mistake and lost significant amounts of money in the market. I'm slowly clawing my way back, but I promise you, losing money on the market is not something that you want to do willy-nilly. You need to have some kind of experience from the losses that you do, and every loss that you have should be a lesson learned. So currently, I'm not trading on my real account. I'm back at the drawing board, so to speak, and trading with only my free demo account. So to learn how to trade and invest properly, you need to gain the knowledge, experience, and know where to look for what kind of news, what kind of fundamentals, and you do that by doing your research and doing your due diligence. Find a mentor that you trust and find a broker and do some courses on how to trade and how to invest. By the way, if you are looking for a trading course, I'll leave some links in the description for the Stock Market College, which is a course that I'm currently doing, and I'll leave a link to my preferred broker as well, where you can register a free demo account and start trading the markets without it costing you any money. I'll also leave some links in the description for some mentors that I follow on social media, and I suggest you do the same. Check them out and have fun. Some of the mentors I follow are The Humble Trader on YouTube, High Strike Trading, and the Dumo Initiative. As I mentioned earlier, trading is regularly compared to gambling, and this is certainly true if you are not willing to learn, you're not willing to put in the work to backtest your strategies and learn how to open positions and find opportunities in the market. This is true not only for trading, but for investing as well. This brings me to the fifth fundamental difference between trading and investing. Trading is not something that you push a button and walk away from. You need to put in the time and the effort, and you need to spend time on doing it properly and watching the markets while you are in positions. I've made the mistake of thinking that working a 9 to 5, I can trade on top of that as well, and I can just enter positions and walk away from it and continue on my day. Obviously, I have to change my strategy and I have to adjust and learn and manage my time in such a way that I can trade without it impacting my 9 to 5 job, but also learn the experience of how to trade properly. With investing, you also need to do the due diligence on the companies that you are looking in investing in. This means spending the time on reading up on that company, doing an analysis on their income and expenditures, their earning ratios, and their pricing ratios on the company. Now, getting back to the question about whether trading or investing is better, or whether you should do either or not do any one, depends on what your financial goals are and what you want to do with your time. As I mentioned earlier in the video, trading is something that you do on a daily basis, and it is not something that you push a button and walk away from. You need to be looking at the markets while they are active, and you need to do pre-market analysis, and at the end of the day, after your trading session, analyze where you were successful and where you were not. On the other hand, investing is something that you only look at the stocks that you buy every couple of months, depending on your strategy, every 2 months, or maybe even as little as every 6 months. Closing off, I would suggest in both trading and investing that you develop a sphere of competence, that you become competent in a small number of companies and forex pairs that you trade with, and a small sphere of companies that you invest in. If you understand how those businesses work, then you can better understand how the market influences those stock prices and forex pairs. And this is also a way of minimizing the risk that you take in opening positions or buying stocks in companies. Warren Buffett, for example, says that he only invests in companies that are within his sphere of competence, which is most likely why he has stayed away from investing in cryptocurrency for such a long time. That brings me to the end of this video. Thank you for visiting. Please check out the rest of the channel for other videos, and I'd really love to hear from you, so please leave some comments in the comment section below this video. This is Yuri Weide-Market signing out. Be blessed, have a good week, cheers.